Oh, and we are live in 3, 2, 1. Okay, thank you everybody for being here today. And we have come a long way since the start of all the webinars until where we are. So we started with like basic technical analysis. You learn how to read candlesticks. You learn to support resistance, all that stuff. And then Bini went through risk management, where you know what to expect, what to think about, what to anticipate in the coming markets. Right. After that, we had easy peasy, where we've gone through about instruments, stocks, REITs, bonds, stuff like that. Right. I covered putting it all together with you guys, just to let you guys know, like, how do you read and interpret information from the financial markets and all the world out there. Everybody is all information overload. And then move on to tools of the trade, and then we got tools of the trade, telling you how to use the platform. So anyway, by now, everybody should have already received your login details. If you have not received your login details, drop us an email with your registered school email for verification, and then we will hit you up back immediately. Also, your trading plan, reminder, trading plan is due on 28th of September. There is a specific format that I want you to put the subject as to send in the trading plan. Otherwise, I receive thousands of emails every day. I might miss it. So trading plan details, how to send in the trading plan, everything's on a Telegram. And today here we are at 26 September, fireside chat for True Singapore Horror Stories, where we have our seasoned veteran investors, traders, and they will share with you about horror stories. And horror stories is not about like what kind of ghosts they saw and see this kind of stuff. The horror stories is their monetary horror stories. Think like you click the wrong trade. You're supposed to buy, you end up shorting, and then you see your market drop right in front of your eyes. You see your bankroll go from green to red, triple digit down, four digits in a single second. Just like how if you long the pound today, you have lost that much. Okay, so without further ado, let's have our panelists in for today. First up, we have Mr. Tim Phillips. Thank you, Tim, for joining us. And now we have Kon Hao, SGX trainer. Reggie, CEO of Investing Mode. Thank you for joining us today. Sorry. The financial component, sorry. And Ping Mei, finally, our last panelist, Ping Mei, is here with us today. So, ladies and gentlemen, we'll have them take this off today.
I can see. Thanks everyone for joining. Can you hear me back there? Is it all good? Yeah, sound? Okay, good. Thanks for joining us for this True Singapore Horror Stories, the investing edition. I think starting with your investment journey, we all know that everyone will make mistakes. It still happens, I think, to the best of us. But when you first start, I think mistakes are obviously more common. But that doesn't mean that you can't go on and be a great investor. So I think it's all part of the learning process. And today, hopefully, we'll dig into some of the mistakes that our panelists have made and see if we can learn from those mistakes and learn lessons. So I think that's the most important thing. Mistakes will happen, but I think learning from them is key to your progress as an investor. So maybe I should just get everyone to sort of introduce themselves quickly. So maybe we can start with Ping Mei, just a quick introduction about themselves.
Thanks, Tim. So my name is Ping Mei, and I'm the Chief Strategy Officer for CGS CMB, as well as the founder of Prosperous. I think on this panel, I'm actually the least experienced investor. And as always, I do have some horror stories. I think we all do. So look forward to sharing a bit more.
Hi. You made me sound very old. Least experience. Okay. It's not just age. Okay, yeah. So my name is Reggie, and I host the Financial Coconut. So I don't know how many of you have listened to the podcast, but we are Spotify, YouTube, everywhere, right? So we are the largest podcast in the space. So great, nice to meet all of you.
Yeah. Okay. Good to see all of you. My name is Kon Hao. I was a floor trader. That was during the very ancient time, right? So, but you have no more floor. Oh yeah. So, but I think it was a floor experience that enabled me to understand the behavior science of human psychology about greed, fear, because on the floor we could literally see them. So I think that actually pretty helpful being an investor, that when we look at the screen, when we look at the chart, when we look at the news, then we're able to see all these behavior science coming alive. So yeah, so that's my journey. And I think 13 years ago, I started my own companies and also invest into full-time and trading full-time as well. So happy to be here.
Thanks everyone. Oh, okay. I got my mic. Okay, I think we can start off actually. So Conhao, maybe since you're holding the mic, maybe we can start with you first. We'll ask the first question. So can you share with us and the audience, one of the most unforgettable experiences you've had, I guess, whether good or bad, throughout your investing journey?
I think because the theme is horror story, so I think I'll start with a horror story. And a horror story is 2008. 2008, you still remember what we have? Maybe that was really long time ago for you guys. So 2008 was the very major financial crisis that we have globally. So I think right now we're going to experience that, seems like again, with an interest rate globally. So 2008 was the subprime crisis. Subprime crisis was the US housing bubble. It led to Wall Street meltdown. And the last leg was banking meltdown. That's why we have Lehman crisis, all this and that. I think the horror story that's so unforgettable was the Lehman crisis. It's all the chain of events that lead to the banking crisis, followed by Lehman collapse. And I was with one of the financial institution. So I was a broker with a house like this, very beautiful, a financial house. And then we heard about Lehman collapse. So immediately it's like everybody just freeze. Said we'll be thinking about, because as a financial institution, not me, but my company have money that plays in US in Lehman Brothers. So if they collapse, we are thinking, all of us are thinking the same note, that what happened to my company, the money with them? And what happened, because all these financial institutions, they also have the client's money with the financial institution in Singapore, and we place margin with Lehman Brothers in US. So what will happen to all this money? So at the point in time, it's really a big question mark. And then Lehman Brothers was a big financial institution in US, so cannot be ignored. So that's the horror story. Everybody just freeze and do not know what is it all about. But I think I want to bring a better light about horror story in terms of some twists on behavioral science or market psychology is this. I think most of us, our journey is that when it comes to shock, this is shock, right? It's shocking. Now, usually when market shock us, it's usually bad news, short period of time, but we will remember it for life. And the bad side is that it will cripple us, and that's bad. Okay, but let me just share with you that I think in life, not just life, but in making money, investment decision, we do have a lot of sweet little victories here and there. Say, for example, I think starting of this year, we recognize that the interest rate is going to move up. So in my kopi talk with my friends, we're in Bermudas, I keep on advocating, please fix your rate for 2 years. If you've got a house, borrowing, please fix it right now. We're seeing that it's coming. So all these are sweet little victories but we tend to not claim it. So it's very important that when of course, we recognize that we also try to sell some of our US shares as well at the point in time. That was first quarter of this year. So all these are sweet little victories. So claim all these sweet little victories, then it will make us be a better person. Don't just remember about the shock and then cripple us. So I think that's my little sharing. I think 2-3 minutes. Yeah. I hope I've not exceeded that. So I hope that don't just look for the shock, but look at your past history that you will come. Your future will become a history. So claim those short little victories that you have. But of course, with all this little victory, it also comes with a lot of hard work, understanding, knowledge and understanding. So play around with it.
So remember the good things as well as the bad. Sound advice. Reggie, how about yourself?
Okay. I don't know, they make me sound so old, like, oh, veteran. I'm not very veteran. It's like my first very, very serious recession, right? So just get a sense in the room, who's a trader? Can I just get a sense, like your hands, like who's a trader? Okay, then who is an investor? Like you're long-term, you pick from fundamentals, blah, blah. Okay, great. So a lot of fundamentalists, we all kawan, okay? Yeah, so my situation is I'm also bottom up, right? So very fundamentalist, and I believe that I know what I was doing at that point in time, right? So who knows this company called Under Armour? Okay, so I think all of you know this company called Under Armour, right? So at a point in time, Under Armour was growing massively every quarter, 20% compounded. Right, so in your head, maybe a bit abstract, 20% compounded, but it's considered very high for a fashion brand. Okay, at a point in time, but because I was new, right, young in the space, I was like, yeah, I know this thing, it's gonna work. Turns out it didn't really work. So that's the horror story, right? But eventually, I think what you probably should do is kind of read across a few financials. Don't just look at one brand. Right, so if you are looking at a fashion brand, probably look at 4 or 5 of them just to get a little bit of basic idea of how's the landscape. Don't just look at one flower and think it's beautiful.
Right? Yeah.
So I have my fair share of horror stories as well. And I would say that 2008 crisis, I was just coming out to work. So I didn't experience that. I would say that, yes, this is probably first the pandemic dip in March 2020. That was the first one. And obviously the reason Q1 this year, right? Markets are on the way down. So this is probably the biggest, I would say the most invested I'm in, also going through the most toughest times. And I think a lot of people in my generation, the millennials, this is the roughest period we've had. We're still quite young. We didn't live through 2008. So I would say that I'm still living the horror right now, but trying to make some decisions around it. So for example, Chinese tech stocks, I think the good thing is I'm not very heavily into it. It's a very small percentage of my portfolio, but I did enter just before the regulatory changes. But I didn't buy individual stocks. I was invested in a combination of ETFs and mutual funds. But let's just say I'm 30% down right now. It's still rate. It recovered a little bit. I guess the question is, do I, double down, do the whole DCA thing? I've done a bit of that, or do I look at as a thing? And it's not an easy decision because I'm very bullish long-term on China. But we all know it's a very difficult market to read, right? So I'm basically trying to, decide what to do. I would say US growth stocks, again, good thing it's a smaller part of my portfolio. Do I have some stocks in the rate? Definitely. Have I had to exit some positions? Yes. Did I make money last year doing a little bit of trades? Yes, I did, right? So you learn, I agree. You have to celebrate some of the wins and what you learn from it as well. I'll just say one thing, a large percentage of my portfolio, because I am actually a more conservative investor, is in dividend stocks like banks and REITs. And that's the portfolio that in this 2 years has fairly weathered well, and the dividends that keeps coming from REITs and all that is still really good. So I would say that, net, I'm actually in the green when it comes to my Singapore REITs portfolio. So you win some, you lose some, and I think learn from the lessons, and where you're doing well, keep building on it.
Yeah, no, that's good advice. I think it's important to know yourself as an investor as well. And I think everyone on this panel is probably quite different as an investor, but there's no wrong way of investing. So I think that's key to remember as well, especially with the style. Okay, so let's move on. We'll stay with Ping Mei since she's got the mic. I think recently we've seen a massive spike in, interest in, I guess, meme stocks, or maybe not recently, but last year. Obviously that's waned a little bit, but, the sort of AMCs, the Wall Street Bets forums on Reddit, I think this really cult status that Elon Musk has at Tesla. And so I think it's more of a chasing the trend. Obviously, that's kind of backfired a bit. So I mean, what do you think about chasing the trend in general in investing?
I think what we see definitely with the new generation, including some of my friends, right, the older millennials, is obviously it's crypto and NFTs. Right. And I still struggle with understanding that space. In fact, I'm in crypto winter. I think that it's not a bad idea, actually, to put in a bit of money and kind of hope things turn out. But at the same time, the use case, right, of crypto is really questionable, right? The fundamentals are hard to understand because there isn't really any fundamentals. So that's one of those trends that, for me, I think it's high risk, right? NFTs as well. I mean, I know the NFTs, it's like, it started with this whole digital art concept and people are trading it, which again, comes down to, is there real value in an NFT? It's different from artwork in the traditional sense where you have that physical item, right? So I think that's one trend that I continue to struggle to understand. And I think we all do realize that this crypto winter has definitely taught a lot of lessons. But I do feel that because there's so much use cases with the technology behind crypto, right, and NFTs, which is blockchain, there continues to still be a lot of believers out there. Nothing wrong with that. I mean, I believe in the technology too, but do I believe in putting on my wealth in this new trend? The answer is obviously not, right? It's not based off a real company with real assets or real profits coming through. So that's one trend I struggle to understand.
Yeah. Reggie, what are your thoughts on that?
I just came from a
trend
crypto
chasing?
panel.
Yeah.
So I
Must be
came
very
from the other
bullish.
side, right?
You
I
must
was
be
there.
very
I was at a
bullish.
crypto panel. So, oh yeah. And then no, I hear the other view. I hear a lot of views every day. So I get what's going on. I will argue that the ecosystem has developed, but it's still very questionable, right? But what was your question again about meme
more about
stocks?
trend chasing. I think a lot of young investors now, they see hot trends that they like to chase, and obviously the price going up, it's exciting. You kind of want to get in on it before it's too late. But I mean, do you think it's a good idea? And what's your advice on that?
I think it's not just amongst the young investors,
Yeah.
right? I mean, the older investors also chase, like Capital DC REIT, like so. Or I think there was a period of time was like cannabis, right? So I think that was like 5 years ago, cannabis, blah 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 blah, and then after that, only left smoke, right? But so there's a lot of that kind of stuff. Trend chasing is extremely normal. You want to kind of ride through if that is your goal. I mean, there was a period of time. I think there was like a meme index going on.
Oh, really? Yeah.
Some research company came up with that. I was like, wow, bro, very serious.
They
Huh?
probably did sell an ETF of that.
Yeah, they probably do that, right? Yeah. So like meme, you kind of work with the flows, right? Pretty much.
Yeah.
So I will say it's quite inevitable, right? To chase after trends when you first start. It's kind of part and parcel of it. Eventually, you will find your style. Eventually, you kind of settle in. Investing gets a bit more boring. That's when you start making money. At first, very exciting. Yes, at first very exciting. Every night cannot sleep. Wow, look. Wow, amazing. But you don't really make a lot of money. When you start making money when you're kind of like bored of it, it's just kind of there. At least from a fundamentalist, you buy and hold kind of situation. Yeah, you compound over time. But this is a tale of the space, right? Everyone says that, but everyone goes through it, including myself. I've done trend chasing, so I can understand where you're coming from. But yeah, if you listen to the OGs, then save yourself some money. Yes.
Yeah. How about yourself?
Yeah, I kind of really agree with Reggie. I think all of us will have to experience chasing after the trend. So I think I would say all of us. It's part of human nature that we will have this greed in us that things are hot. We will tend to chase after it, right? So I think my time, I experienced that I chase after my trend. Maybe there was 20, 30 years ago. Yeah, I mean, whatever is hot, it can flip very quickly within a short span of time. It draws a lot of interest even to me. But of course, I learned my mistake. Yeah. So then it's not crypto. The crypto is not available yet. That was about 25 years ago. There was all these penny stocks. Penny stocks you can flip very easily from maybe 20 cents. If it's good, some news release, you go to maybe 60 cents, 80 cents, $1. So there's a flipping a few times. Then, of course, as a young man, then everything seems very juicy because everybody will talk about it. So it's a human nature that we'll draw to it. We also want to participate in it. So it's very difficult to avoid it. But I think the blessing that today, your time and my time, I would say our time, yes, because it's not fair for the rest. And my time is that there's no other avenue that we can educate ourselves, right? So really, literally, we have to pay the price. We're chasing after the trend. So chasing after the trend is not just in this generation, but in generation to come, everyone will chase after the trend. It's part of the human nature in us. So again, something that I do not have today, what you have is that we have to learn through the hard ways. Even last year where the crypto was hot, my friends in the 40s and 50s will come to my house. We have dinner together. They'll talk about, they're in different industry. Then suddenly they became crypto expert. So they started to ask me about, have you bought crypto, all this and that. I said, no, I don't understand, just like what Ping may say, right? Things that I do not understand, but there's liquidity, there's volatility. I recognize that crypto then and even today is not for investment. There's liquidity, there's volatility is for trading. So you have to differentiate between investment and trading. Trading is that I have no sentimental value over it. I get in, make the money, get out. I get in, I lost some money, wrong judgment, get out. Investment is different. Investment because we know the value. So I told my older friends in the 40s, 50s, I say that, are are you aware what you're getting into? So I preach to them in a way in our dinner is that there's a difference between investment and trading. So just be mindful that what you dabble in is trading. So make sure when it starts to turn, you have to turn as well. So what I'm trying to say here is that if then my time when I was 20, 30s, I'm drawn into all these penny stocks. So most of us also draw into all these penny stocks. But I think today you're better equipped. Why? Because you have all these online platforms that you can watch it from home. You can be here. There's so many social media channel. There's available YouTube channel that you choose the right person that you want to listen to. Yeah, those that sell on some concept that is too good to be true, you just got to be very careful about it. Now, learn something from these guys, but you have a lot of avenues to watch channel after channel, videos after videos. Maybe listen to some very wise friend of yours, ask them to recommend what channel should I learn. Then you just enjoy it, you know.
Yeah.
Take the process, enjoy the process, go through it. And I agree with Reggae is that making money can be slow, but it's good. So I'm with Ping Mei as well. I love the Chinese market right now. Yeah, so it's that one is for long term, where I believe that the transition to come will be for the Chinese market.
Okay. Ping Mei, maybe like we can sort of take this next one. I mean, we just talked about trend chasing. I mean, are there any hot trends right now that you think young investors or new investors should be a bit wary of or think twice about?
I'll be honest. I think the current market conditions, it's not an easy time to make decisions. I'm not sure what exactly is trending. I think crypto and NFTs continue to be popular among younger investors, though of course everyone's a bit wary now. I don't think anyone's super excited or anything unless like chasing after something that's giving you higher interest rates. I would say this. I think I think the other downside of the current market conditions is where do you put your money, right? I would say don't chase after any trends. I agree with Reggie, right? You know, when you want to make real money, it gets really boring. And to the point on trading and investment, right? Don't trade away your hard-earned wealth, right? Even if you decide you want to do a bit of trading and make a bit of money, do not put all your savings into trading, right? Remember that long-term wealth creation, that's investing. So you should segregate your so-called portfolio accordingly. It's okay if you want to take a bit of risk because you guys are all young, right? And sometimes chasing trends, you can make money. I'm not gonna lie, I love trading Tesla, and I've been doing that on and off, right? Because it's one of the most volatile stocks out there. There's a lot of liquidity, and you know, within a 1 month range, you see. I'll just say this: so far, I've made a little bit of money here and there with Tesla, but I don't go big. It's a very, very small percentage of what I'm willing to lose, right? Right. So it's okay, I think, sometimes to chase certain trends, but you have to know how much you can afford to lose. Because when you're chasing after that trend, it could really go to zero. I think it's important to know that risk tolerance that you have, and definitely don't put 100% of all your money into those trends. I think that's definitely taking too big of a risk.
Yeah. Reggie, how about yourself?
Can I run a poll?
Sure.
Yeah, I mean, there's a free polling mechanism here, right? So yes, I want to ask, like, how many of you, can I get a show of hands? Like, how many of you are in crypto? Oh, so conservative, this crowd. Okay, then okay, how many of you was in crypto but you have exited? Okay, you're kind of there. So yeah, the diamond hand. Okay. Then how many of you are actually invested in the stock market? Okay, so like, can I get another hand? How many of you are invested in the US stock market? Okay, so pretty much everyone that's invested is invested in the US stock market. Okay, so I think currently, because the market is very down, right? So very sad, everyone very sad. I always tell you must play safe, right? So that's the it's true, right? Very sad. Everything very sad. Every day when we go live and talk about the markets, I know, very sad. Always very sad news. So every day is like that. So it sounds very depressing. There's no real trend to kind of chase. I think currently the trend is ESG. And there's a bit ESG. Sorry, I hate it. Okay, so let's be clear. I love the movement. Okay, I like that we're going green, by putting it in front and making it a thing and, trying to get more people. So, I mean, as you grow up and you keep thinking about this, eventually maybe half of you will end up in some sort of a green sector. You will end up in some sort of social sector, something along those lines. So I think that's great. But to put a score on companies like ESG score and expect it to outperform everyone, then what is a question mark? Right, and that's half the movement at this point. So I don't really like it. But instead of saying any particular trend, I would say maybe you got to think of some investments as a moonshot idea. Right? So have you heard of this line, moonshot idea? Right. So I think if you read Google or you're kind of like in the space a little bit, you hear this thing called moonshot. Essentially, you have the core portfolio, which is a little bit more boring, right? Everyone, and then one you don't need me to tell you, everybody will tell you, must play safe, DCA, blah, blah, blah. Right. So everyone tells you the same thing. You do that. And then there are some of these things that are like moonshot that are out there. Maybe you can like 10x, 20x, 100x out of those things. And that could like outsize your portfolio. So I think that's my position when it comes to investing. Don't need to be too safe. You got to be, you have some core, but you have the satellite, right? Which is like your crazy ideas that could get you really far. And to be clear, you're all very young, so you can play around a little bit. When you're in your 50s, different. Don't heart attack. It's different thing.
Definitely. How about you, Kohal? Any trends you think people should be wary of?
Yeah, first of all, I'm 50, just crossed 50. Yeah, so but let me share with you.
Yes.
I think I told a lot of my friends that I can live up to 100. I think that's what Minister Heng Swee Kit said recently, that we will live up to 100. So I think we eat good food, healthy food, we stay strong, we exercise regularly. I think it's important. And we always enrich our mind in events like this, because I think the only organs that keep on growing is our brain. Our brain are functioned by a lot of neurons. That's the only organs that will keep on growing, even you grow older. So the question is the hot trend that the Gen Z are chasing after.
Yeah, things that they should be wary of, maybe.
Okay, so maybe
right
I think I will follow Reggae South to ask you, so what is hot to you right now? Because I think the crypto is things of the past, right? Not hot at the moment now. So I'm not too sure. We are not too sure whether it will come back again. So in your opinion, what is hot right now? Yeah. Yeah, just give us some, because I need to know what is hot.
Like meme stocks, right? Meme stocks?
Meme stocks aren't hot right now. You weren't kidding, but in solid index is ETF, and unfortunately, it's not performing well. In fact, it's here. Hang on, let me show you this.
Yeah, but it's true. There is a meme stock index.
There is a meme stock index, yeah.
Yeah, so this question is a bit difficult to answer because nothing is hot right now, right? Yeah, but there's something that's very hot right now. Interest rate is very hot. It's going up. It's trending up. Yeah, T-bills, right? Yeah. Yeah, but you can consider that. Like for example, like what I say, the first quarter of this year, 2022, I asked my friend to fix the housing rate, their borrowings tenure at about 1.6. That's hot because you are seeing that it's coming. If you fix the rate for the next 2 years, in fact, you save a lot of money. That depends on what's your loan. Is $1 million loan every year can save many thousands of dollars. So you just think in terms of what is hot right now is interest rate is moving higher. So what is that you may not choose to invest, but by not heavily in debt, that's saving money, that's making money, right? Okay, let me just maybe get to some relevant here is that what is hot right now? Okay, I think my feel is this, is that generally, I think even for Gen Z yourself, you know that interest rate is a difficult subject right now, that inflation seems like over the world is mismanaged. And interest rate will be trending higher. And that's bad news for the economy. Now, so then what I concern me right now for the millennials, not so much on Gen Z, the millennials will ask me questions like, if I'm going to buy the big names in US, it should be okay, right? That's scary. Okay, so maybe I can ask you this question. What is the big names right now that you know that can buy? Apple, Amazon, Microsoft, right? Because I cannot be specific on the companies. That's what you say. Okay, Apple, Microsoft. Yes, correct. Yeah, I work with the regulators in Hong Kong, so I'm very careful about this. And now, so my concern is that the millennials they say that yeah, market is coming down. It's okay. I buy the big names. It should be okay, but to me, it is not okay. Yeah, because you have to understand that the name that he have named the few, who are their major customer? Their major customer are the mass market. Okay, middle income, mass market, student like yourself, maybe you're holding one of their product today. Now, so when recession hits, what will happen to the major market consumption? We will tighten our belt, right? So instead of buying one gadget every 2 years, I think we will buy one gadget every 5 years. Wait until the gadget conk, then I'll buy. So
would the exception be Microsoft to that? I mean, I'm a
it could
big
be,
Microsoft
it could be.
guy, so I mean, like enterprise spending. I feel like Microsoft has cloud. It also has the Office, and it does have one arm with gaming. But I think it's definitely a lot more insulated than maybe some of the other big.
So you got to be very selective. So if you just go on the notion of buying the big names, it should be okay. You just got to be very careful. So like what Tim say, be selective. Know what you're buying. Because I'm not suggesting that all these big names will collapse. I'm just suggesting that in a time of recession, these big names, their earnings will be much reduced. So in a retracement concept, means that if this is $100 today, possible all these big names they're serving the mass market, if the mass market tighten their belts, their revenue be contracted as well. So I'm talking about a retracement of say 30% or maybe 40%. Yeah, and that's, to me, that's a lot. $100 to $70 or $60 possible. It may come, and that is a minus to those investors. So be mindful about it. It's not chasing of the trend, but I think what the trend right now in the millennials is that buying all these big names should be all right, isn't it? I would say no.
Yeah.
I actually very much agree with you because that's why I'm sitting on more cash than I should, because I'm kind of waiting for the recession to hit, because I think a lot of views is by next year it's going to come, especially in the US, right? It's inevitable because of all the interest rate hikes that's so aggressive. And obviously I'm hoping for that good buying opportunity. So I think one thing we know is it's good to stay invested even in difficult markets. So I continue to, invest a little bit in every now and then, but I am struggling to find what I would say, what I think is fundamentally sound or value. There are some, of course, and there are still some recession-proof industries, right? That sectors that one can go into. But I must say that I am holding on to quite a bit of cash in hopes for that retracement to happen. 30, 40% down. Oh, I think that's a great buying opportunity. But again, no one can truly time the market, right? So you have to be mindful that no one can really tell when it's going to come down, right? So it's also important not to, completely exit right now. Some people do that, right? It's down 20%, 15%, you rush to the exits, and then, not only have you realized losses, you're not invested. And even if you put your money into T-bills right now, because it's going up, there's no guarantee you'll beat inflation, right? But of course, if you are planning to hold on to cash, right, instead of leaving it in the bank doing nothing, then T-bills is a better option to kind of like keep your cash there for a bit.
I will challenge that notion.
please.
More exciting, right?
Yeah,
Everybody
exactly.
agree, very sian. Okay, yeah. So you talk a little bit about cash sitting on the side, right? That part I agree. Okay, but the part about defensive stocks. Have you heard this thing called defensive stocks? You probably heard, right? And the analysts always tell you, bad times buy defensive stocks, right? I work with many analysts, so I cannot say who, but generally when the analysts come and tell you, you should look at defensive stock, blah blah blah, rotation has already happened. So a lot of those stocks have already rallied, right? A bit sian already. And to be very clear, when people talk about defensive like FMCG, right? Your Coke, your whoever else, your P&G, and all those guys, right? They're all. How much? Wait, do you guys understand PE ratio? Price to earnings. You probably have some lessons, right? Okay, so their PE at 40 currently. Okay, so price to earning ratio about 40. I don't go into the nitty gritty to explain it, but Google currently is trading at about 20 plus 25. right? So if you think about it, relative to those guys, Google considered relatively cheap. You can't directly compare, I get it, right? Depending on your thesis and all that. But price to earning, I would say big tech today is cheap relative to your defensive stocks. Okay, but this is not recommendation. So I must say, if not, but I'm not licensed, I can say a bit more.
Yeah.
But yes. The idea here is you must kind of know what you fundamentally want and what is your situation, but also understand that a lot of these advice that people give out there, you need to contextualize it, right? If you don't contextualize it, it's all fluff. Okay, in my worldview, because if you don't know what you want, you don't know what you have, everybody tell you everything. Oh, it's like walking into a shopping center, everything also the same idea. Okay.
Yeah, I agree. I think like a lot of these consumer staples, which are considered defensive, they're trading at like multi-year valuation highs, right? And so markets are forward-looking. So expecting a recession next year, the market wants to go into these names because they assume that their earnings will hold up better, which it might be true. But I feel
we are aligned with Microsoft.
But I'm aligned with the fact that this shift has already happened. People have gone in because it's defensive, right? So I think you have to think about what is the longer term upside over sort of 5-10 years from the point that you start investing. So that's a good point that Reggie made as well. Okay, let's move on to the fourth question before we run out of time. Maybe you can take this, Reggie, since you're on the mic. What today's environment, what is it like for young investors, and what are some of the red flags that we should watch out for in companies that we invest in?
I think we are in a world where there's a lot of information, right? It's unlike the past. There's a lot of information and there's a lot of short information. Your TikTok. I don't know. Even I have to be like TikToker now, right? No one listen to 45-minute podcast. Must listen to 45-second TikTok. Right? Quick tip. But the reality is, if you really want to be a good fundamental investor, you have to read lah. Okay, trust me. Okay, just go and read this one company called Estee Lauder. Do you know Estee Lauder? Like the makeup, they have like 40 over brands under them, right? After you read Estee Lauder, you can go to MBS and you know why all the brands are there. They essentially book 3 levels. So they got economics of scale, right? And once you read the financials, they will lay down how they work, what is their business. They license all these other brands, right? So a lot of brands are under their house. So I'm not saying you definitely have to invest in a makeup company, but the idea here is once you read through 2 or 3 of the same player in the game, you will have a better idea. Oh, so this person actually don't produce. They just give me the brand. I pay them 5 million a year. And then I sell on behalf of the brand. Let's say like Fossil. Right, Fossil got makeup, got everything. Right, okay, maybe don't have. I don't know. Cannot remember. Yeah, watch. Yes. Fragrance. I think they got fragrance brand, and the whole thing is under Estee Lauder. So they only, pay Fossil like a few $1 million a year just to buy the brand, license the brand, right? So the idea here is, as you read, you will learn more things. You have a lot moment. Okay, and you will get a clearer idea of how the world works. It takes some time, slowly. And if it's very boring, I get it. It's very boring. Right? A few friends read together. Okay, a few friends read together and compare notes. That's the best. Okay, I think that makes it a bit more fun. I mean, that's all part of learning. Yeah.
Yeah. May, what do you think about some of the red flags that you think some of the
I agree with Reggie on there's a lot of information out there, and sometimes the information in bite sizes doesn't give you the full picture. So, investing aside, fundamental investing aside, even for trading, to become a good trader, to learn up technical analysis, you're not going to get it from 1-2 YouTube sessions. There's a lot that goes into it, right? And there's a lot of learning that comes from it. Again, not every chart is going to move the same way, right? So how do you read the different scenarios? And I think getting good at anything takes a lot of learning, and sometimes it is worrisome, right? Because we know that every generation, things are moving faster. There's a lot of news. Everyone seems to think that, Wall Street bets or, Reddit is the way to go in terms of making money, but that's not how you make money in the long term, right? It's the same thing with your careers and your jobs. If you think that you're going to have the next startup and make money in 5 years and be the next Facebook, that rarely happens to everyone. So even in your career, it takes a long time to build up, your career. So yeah, I think patience is very important, regardless what you choose to do, right? And especially for investing, trading, learn, take your time. Don't look for, a quick buck.
How about yourself?
Yeah, I think maybe some more relevant to today's context here is that in the environment, again, rising inflation and interest rate, that's something that all the companies have no control because that's macro, right? And I think in that context, what the red flags that the company that you are thinking of investing or holding is, I think, two parts, since you know that highly likely that inflation is still be continuing on the rise, recession likely to hit US and then followed by the rest of the world. I think the company that you have right now or about to invest, look at two things. Make sure that the cash flow is good, because when interest rate move up, recession comes, individual, we need cash flow. So what's more about company, right? Then the other thing is the gearing factor. Gearing factor means that there are borrowings. So make sure that between whatever they have and the borrowings is not too high. Why? Because when interest rate is moving up, every month they still have to service their debt. So as interest rate move up, as they service their debt, that will eat up to their net profit. So I think in this context, the red flag right now, that look for those companies that you are looking at, eyeball, two things, make sure they have good cash flow and also that they don't have too much borrowings, because as they move up interest rate, it will eat into them.
Good. No, good advice. Okay, so I think we can move on to some of the questions that we've got pigeonhole. We've got some that have been upvoted, as you can see. So I think we'll start with the top left-hand corner. So what are some stereotypes on investing and how do you combat them? Ping Mei, do you want to start with this one?
That's true. That's true. I was actually going to go back to meme stocks. I think there is that stereotype that you can make money quick if you ride the trends. I think we now see in the current market conditions that's difficult. So how do you combat them? Well, I agree with a lot that the panel has said, right? You have to know yourself, your risk appetite, and do your research, right? It's important not to get emotional. I think, we talk about psychology. Human psychology is very easy, especially the first time you encounter markets like this, that you will overreact, right? And I think a lot of us learn the hard way. The first time you make a mistake, you tend to either sell too fast or you hold on too long, right? Because you're emotional, you think the stock is going to rebound and it doesn't, right? So very important to not get emotional with your decisions. And this also ties back to the stereotype. Some investors invest only in companies that they like, right? And when you invest in a company you like the product, but is the company a solid fundamental company? The answer could be no, right? So again, emotional investing, I think that's also definitely one of the most common stereotypes. And like Reggie says, right, when you become more experienced, it becomes boring, right? Because you take the emotion out of investing, right? So you're no longer riding that emotional, oh, is it up, is it down?
Yeah, that's why Under Armour very jalan, right? Oh, I like the product. Wow, amazing. Wow, then the business jalan. But that was for its time, right? I would actually push on the whole idea of being emotional, right? You hear this all the time. People tell you don't be emotional, blah blah blah. But to me, right, when I feel like if you're emotional, it means that you don't really understand what's going on. So it's a signal rather than something that you should suppress. Okay, so I take a very different view on this thing, right? That means if you're emotional, a lot of financial content will tell you, oh, you cannot be emotional, you must suppress it, you must dissociate, blah, blah, blah. But to me, if you are feeling emotional, it is a very clear sign that you are kind of lost, like what's going on, right? It's out of your thesis, it's out of your sphere of understanding. So instead of suppressing that emotion, you should learn to work with it as a signal to tell you that, I don't know what's going on. Right? Because as you move along and you know what's going on, you have a little bit more clarity whether or not you're actually accurate or not. That's a different discussion. But as you have more clarity on what's happening, you will tend to be less emotional because you're a little bit more aware. You feel like things are a little bit more in control. Right? So there is some sort of correlation between experience and emotion. So it's not something you should suppress. Take it as a signal to work with it. Okay. As for stereotypes on investing, I think there's quite an interesting bunch of people out there that either do ETF or do like single stocks. It's like macam they're like loggerhead, or like they just trade or they invest, like Wu Tangshan and Zhao Lingsi, like always separated one. But the reality is, I think over time, as you develop to become a more experienced investor, sometimes you get very tired to do the same thing, and you can just buy broad base, right? Let's say you want to do pharmaceuticals. A lot of people think pharma is a simple space to go into. It's not. It's a very complicated space to go into. But there's some interesting opportunities. So instead of picking individual, you can always buy broad base. So I have come to that position where certain things I can pick, certain things I will just buy broad base. Yeah, so I'm not so die-hard. No, I only can pick stocks. Only can buy ETF. Right. So I think that's a little bit of a, I'm kind of like middle ground that way.
Yeah.
Yeah, for stereotyping, I think that not forget about Singapore market. Yeah, because why I say so, that a lot of investors, of course not Gen Z, outside, yeah, they say that Singapore market, how to invest, so boring. Yeah. Yeah. So let me clarify that. Yeah. So yes, Singapore market was boring. Now notice the tense that you use, right? Was boring. I think since about 2008, the Lehman crisis from 2010 to 2022, do you realize that Singapore STI still stuck at 3,002? At 2010 was about 3,000. Today is still 3,002. You have not changed. Yeah, why? Someone say why? Okay, yeah, let me explain. Of course, the time I will not able to explain to you why the range. So I worked with SGX for a long time, as partnership with them for a long time. So over the last decades, I never really advocate Singapore market as buy and hold it forever. Because if you look at the whole trend, Singapore market is been range bound. Over the last 12 years, 14 years, it's been 2006, the lowest point, 3006, the highest point. So about 1,000 point range over the last 14 years. So I always recommend that Singapore investment strategy is you don't be passive. You got to be active. So within the last 14 years, there's about 3 to 4 cycles, 2006, 3006. So you just focus on this cycle, you will be quite happy more than the US market. So because the strategy to invest in Singapore market is different, it's a range bound market. But I can tell you that moving forward, so the last 2 years, including this year, and moving forward, I'll be very excited as an investor and working with SGX as a partner. I will advocate Singapore like never before. In the last 10 years, I never quite advocate that buy and hold Singapore market. But if you notice, most of my webinars, my YouTube channel right now, I've been asking to buy and hold Singapore because the trend is, it may break this trend of range between about 3,006 the top side, but it will not be the next few years, but you hold it long enough, I believe it will come. Let me just give you a very quick one. Why is it so? Things have changed. Do you realize on the ground that a lot of tech companies are setting up firms in Singapore like never before? So we are now a financial hub. We're always behind Hong Kong, but today we are number one. I'm number one in Asia, right? So we have financial hub, we have tech hub, okay? We have biotech hub. We are biotech hub. There's so many hubs now. We are trade hub now because PM just announced during the national rally that we're going to double our pot size. They are saying that with trade wars between nations, the big nation, the giants, but we can play an intermediary role. We are not just that. I think there's a lot of hub, even the green hub to come, the ESG, right? Yeah. So, yeah, can you see that these trends are exciting that we're all here today? And not forget about Singapore, about stereotype. Don't use the word Singapore is so boring because cycle moves. Yeah. So what was hot was US, but that may be a transition. The West to the East. At least personally, that's what I'm saying here.
Yeah. Okay, great. I think maybe we can move on to the next question. Okay, say one student has a net worth of $10,000. This is difficult. How much money would you recommend him or her to allocate to investments? Reggie, do you want to pick this one up since you're so amused by it?
I don't really
No.
Go ahead.
I'll give a generic answer. Again, you have to ask yourself, right? What are your investment goals? How much risk can you get, right? If you have a net worth today at 10,000, right? But how much is your so-called income? Are you just purely on an allowance basis? Do you have some savings from that allowance, right? So budgeting, basics of financial literacy, know how to budget, right? Know how to save money, right? What's important, I think, at the start of your so-called investment journey is you want to not lose all your wealth, right? All your net worth. You want to be able to grow it slowly and responsibly, right? So again, we talk about, asset allocation, right? Again, higher risk profile means you could put a higher percentage to riskier investments, right? But no, you may lose 100% of it, right? If you're extremely conservative, you would like to see that wealth of yours grow very slowly, then again, put your money into very, very passive investments, right? Again, if you don't know how to pick stocks, right, because 10,000 is not a lot, you can put into broad-based, index. And if you want to be extra safe, then you do DCA, right? So every month you put in a bit. So there are a lot of ways to invest, but know yourself first and foremost, right? And very important, before you start investing, please budget safe. And also it's important to learn how to make money, right? Like I said, career is important because you want steady income, right? Then that way your wealth can continuously grow as well on an uptrend.
It's usually like just put up there, yeah.
Yeah. Oh, my turn, huh?
Yeah, your turn, yeah.
So yes, firstly, right, if you're a student and you have 10,000, right, quite good lah. Oh, you've done quite a great job accumulating. You should give yourself a round of applause. But the reality is, it's not a lot of money. No matter how high you try to milk this 10,000, right, ain't no shit's gonna happen. So it's just too small. 10,000, you double up. It's amazing if you can double up, right? That means at 100% growth, right? That's then you get 20,000, and then you ask yourself, what's next? I'm gonna double again, 40,000. You double again, you barely make the down payment. Okay, this is the reality. Okay, so if you're already at 10,000, great, good on you. But if you are thinking of banging on this 10,000 to become like a millionaire, right? Just forget it. So this is the reality. Okay, reality of the game. But I think something to think a little bit more about is this idea that if you lose 50%, you actually have to double up your money to come back to your capital. Right? So if let's say you have 10,000 and you lose 50%, you're at 5,000. So in order to come back to your 10,000, you gotta, profit at 100%. Right? So it's actually a lot harder. That's why Buffett always say you don't lose money, right? Blah, 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 blah. Right? And those things you hear all over the internet. But I think, the base idea here is you can stay invested, broad-based, you want to pick your own stocks, up to you, you can experience, but don't idolize that this 10,000 will get you very far, because once you go out into the real world, you work a few years, right? You have, no problem. Okay, so really, if you at this age can save 10,000, you work 5 years in the market, you work 5 years in the job, you'll be fine. Right? I mean, that's my view lah.
I think, to me, I hope to share some light here is that if you have 10,000, right, you'll be as good as you have $1 million. Yeah. Let me share with you how it works here. Your $10,000, today we have a lot of micro products that you can invest in. What do you mean by micro products? In my past, we can only buy one lot. One lot is 1,000 shares, right? So $10,000, I cannot do a lot of things. I cannot even buy one DBS. But now I can buy a few shares. But of course, you have to consider about the commission. So what I'm trying to say here is that with $10,000 is, just think in terms of you have $1 million as $10,000. So if let's say you can achieve a 20% return at the end of the year, the next 12 months, that's about 12,000. So don't despise the small beginning. $10,000, you have 12,000. So your brand new year is going to start at $12,000. Then you try to make it 20% for the next year. Then it's no longer 14,000. If you make 20%, because the first year you make 20% is 2,000, so it's 12, right? So your base is $12,000 the brand new year, next year. So when you make 20%, it's not 14,000, by the way. It's 14,000 few $100 because of the compounding factor. So what I'm trying to say here is that if you are good steward of that $10,000, even you have $1 million, you'll be as good. So you can imagine you've got $1 million, you can make 20% of that whole entire year. That's $200,000 earning. So start with $10,000. If that's all you have, which is good, then do it. But focus on the percentage gain, not the absolute dollar value. I think that will just keep on working on it. So focus on the performance, not the dollar value.
So I'm not dissing you. If you got 10,000, we all start somewhere. I also started with 10,000. So I agree with the theory. It's not wrong. I'm just saying that I see so many people, because I run the podcast, right? So we have a lot of questions that come in, and I see so many people trying to crack their head over how to milk this $10,000 to become a millionaire. Okay, so yes, question.
The $10,000 is clearly insufficient, but what do you suppose would be a much more realistic amount to get started with that?
I would say something completely different to the panel. I would think this is a question that is talking about allocation, right? So how much are your outgoings? What is your cash flow? Are you earning money? Are you living at home, or are you paying rent? What are your outgoings? And so what percentage of your allocation? The 10,000, to be honest, is to me, is quite a meaningless number. It's just $10,000. But if you're going to start working, you graduate, you're going to start earning money, right? So then you start earning money. Are you going to be at home? Are you going to be living with your parents? Are you going to be saving on rent? Does that give you more disposable income to invest, to save up? Or do you want to spend it more on consumer discretionary items? So everyone is going to be different in terms of their profile of how they spend, what they invest in, how they invest. So for me, this seems more of an allocation maybe / cash flow question in terms of, where do you guys see it going in sort of 5-10 years, rather than 10,000 to $1 million. Yeah, it's just, that's just not going to happen, right? As Reggie said. So to me, that's not, maybe I'm interpreting the question a bit differently from everyone else. Yeah.
And I just want to add last thing on it. So I think, but all that being said, right, if you invest and you track, right, so you track 3 years, 5 years results, I know people that based on their personal investments get employed in some of the biggest fund houses out there. Right, so you don't have a lot. Maybe you have 50,000, you have 30,000, and then you trade, you invest, and then you keep your records, right? So you track it, and you're here. You're already a select bunch of people, right? You're not like out there doing nothing. So if you're already select, that means you have some sort of tendency that you're exploring maybe a career in finance, and tracking your own personal investments over a 3-year, 5-year, 10-year period could be a very good portfolio, in getting interviews and all that. Yeah, so many people have done that. Okay, it's not a rando one-off person. So yes. So I would believe you track your performance. I think that's a bit better.
Yeah. Okay, cool. So maybe we should. Hey, so this is a good one. So I think this maybe I can direct this to Con Hao, because he was talking about tech stocks earlier. And in one of the webinars, it suggested that with constant technology advancement, tech stocks will not go away soon. So is it not considered safe, quote unquote, safe to invest in these big players for the long term?
Yeah, I think tech stock is definitely here to stay, because earlier I mentioned about tech hub, but in every industry, there are cycles. Yeah, so we just witnessed the top cycle of the US tech stocks. So wait for the correction to come. I think with Pin May and definitely with all the panelists here, that be patient. You mentioned about patient, right? So be patient and recognize that there are cycles. Even for tech stock, whatever that's hot, there are cycles. So I think the tech stock, the cycle is just off from its peak. So be patient. So technology is definitely the way to go. Maybe you can give Pin Min a call. Yeah, she's in the mandate of keeping some cash. And while keep cash, where can you let the cash go? Maybe Singapore market is boring, right? Boring means that the downside may be limited, but yet Singapore market is one of the most handsome dividends around the world. So that will be a reggae idea whereby don't keep too much cash. So then you look for safe haven like Singapore. And Singapore is really safe haven. I can tell that I never spoke about Singapore so much in my life over the last 2 years, because over the last 12 years, I don't see any proposition to invest in Singapore stock, because I don't see a major trend that's coming up. But I think this year moving forward, I think Singapore is a safe haven because downside is limited. Let me give you a perspective. US currently is down about 30% or more from its top, right? Yeah. But Singapore from the recent top at the same high around November, December, or January this year, guess how much you have levered down? 5% only. So you see where the hot money is going into. And so again, tech stock definitely is, to me, is a buy, but can be patient. But I tend to like tech stock in China though. Okay. Yeah, because now it's like they have their soft landing. Yeah, to me, if they have achieved a soft landing, so I like it personally. Okay. So again, you can give Pinmin a call. Yeah.
Cool. Okay, so Reggie, how about you take this one? What is one lesson or quote that you strongly believe in when investing?
One lesson, a quote. I don't know what this. There's so many. You can listen to my podcast. Okay, but can I chime in on the tech one?
Yeah, you go.
Yeah,
go
I
for
just
it.
want to share a little bit, right? So tech is an overarching term, right? That people use for things they don't understand. All these new things that people don't understand, all under tech. Okay, eventually they will have a name called communications, called social media, called something. Eventually, all these tech companies will start to become sectors in themselves, and they get phased out of the tech index. So this is a pattern that you see across decades. Sun Microsystem, Microsoft, Adobe, all of them eventually become a creative design software, enterprise software, CRM, right? So anything that is in the tech label, that means people don't understand this business. Okay, it's still in the question mark stage. What is going to happen? Eventually, they get phased out and they become a sector in themselves. Right? Today, you will not say Facebook is a tech company. Facebook is social media, Pinterest social media, Snap is social media. Right? So you will see them differently. And what happens, the interesting part that happens between here is the phase where they go from growth to value. Okay, so in growth phase, which are all lump and tech, right? Always very exciting one. The fundamentals don't matter, just move when they grow, TAM. Everybody talk about growth, when they're in that phase. But once they enter into a sector, they are viewed relative to their partners. So valuation metrics in the whole financial space will start to look at it differently. So now PE matters, cash flow matters, okay, revenue growth matters. So it changes. And I think that's the part that if you are a tech investor for long enough, you will be a little bit more aware of this thing. Okay, that change. And when it changes, the market will reprice it. Okay, so I think there's something interesting that I've observed in the tech space that, not a lot of people talk about. You can think a little bit about it.
Yeah. I think that's all the time we have for now. If there's any questions from the floor, like, does anyone want to ask something? Yeah, before we sort of head off, I think you can pass the mic. Yeah, there's a mic here. Yeah.
Thanks.
If it's on. That's it.
Go ahead.
Hi, thanks for speaking. I'm Daryl, and my question is, so in the bear market, the risk is higher, the yields are lower. What do you think is the most critical change that we must make for ourselves, our portfolio, so that we can face the future effectively? Because at some point, right, in this bearish market, the price of the stock completely disassociates from the fundamentals. One day it could rally all the way up, one day it could come crashing down. A new CEO steps in, but the price still goes down. It could have an amazing new record profit, right? Price still goes down. How do you really navigate through such a difficult path?
We pass to the most experienced investor with almost 30 years experience, 20 over years.
I think I will. Yeah, I think I will use their strategy, all of them, because Bing Bing is into cash, holding cash, right, at the moment. He's very dynamic, so we have to be dynamic as well in how we think. And then for Tim is allocation. So when bear market comes, so certain stock doesn't make sense, right? So holding cash is part of the factor, but holding too much cash, as what Reggie says, so not ideal. So therefore, you can put into safe haven, like Singapore, not all of it, some of it. Then why you have to understand that why the bear market comes is because of inflationary, in today's context, inflationary context, right? So in inflationary context, what market will go up? Not too difficult, no? Okay, we have time, right? What market will go up? Commodities market will go up. Commodities market will go up. So look for, like what I think Reggae into ETF. Look for commodities fund, ETF funds, commodities stocks that pays dividends. Because when the market is inflationary, bear market comes out, there's always a balancing somewhere, somewhat will go up. Okay, so I'm into allocation, Singapore stocks, some cash, some Singapore stocks, some China stock, lesser of the US stock right now, and also into resource fund, ETF fund, commodities fund. So there's a lot of allocation that team has been speaking about. I think it's really the contribution of all of us. Yeah, so these are good questions. And I was telling Samuel earlier that I'm glad that this thing comes because it kind of, because when things are too pricey, I also scared to buy as investors that to invest, right? So let the storm comes because then you will level down, then I can shift the funds around allocation, then start brand new. I think that's the exciting part about market. So keep on looking at the macro, where to shift your money, shift the fund, be dynamic like Reggie. So yeah, so it's a combination of today we have a good combi.
To that, right? I think whatever you were saying just now, like, new CEO, the price is disjointed from the reality. I can say that in the growth stage also. When things are high, things are moving, things are exciting, also disjointed from reality. Right? Your PE trading at 100, how is that reality? So the same can be said on both sides, right? But I think what you're coming for is you are looking at some of these companies that are in the early growth stage, right? They're like crazy, they're growing, they're doing nuts, like they're trying to break through. I mean, that's all the growth investors always talk like that one. Okay, so I feel you, bro. I know, huh? Okay, and the reality here is in a bear market, you want to make sure that they will not collapse, right? So what is the fundamental cash flow of the company, right? Is it working? Can they cut some expenses? Because some companies are very lean already, but highly unlikely, like they are in growth, right? They probably have very, very high, cost on operations, right? So their OPEX should be quite high, right? So as long as they don't go bust and they continue to stay dominant within the game, they will tend to turn around. You will see a lot of M&As now. Okay, a lot of the smaller guys that cannot merger and acquisition. Okay, that means you too small, you too jalat, right? Then you merge with the bigger one. Okay, so simply put, so you see a lot of that. Whoever that survives through this period usually have some sort of cash flow generation, or have good enough credit rating that they can take relatively low cost loans. And corporate loans are not low. If they're in the B, the 8%, 10%, it's not low. You cannot use that for growth. Growth companies will die in such a situation. So yeah, you got to look for companies that have some sort of positive cash flow. They don't need to be making a lot of money. If they're positive cash flow, that means they will not die already, right? And then can they kind of ride through and turn through? Are they dominant in their space? Are they number one? Can they have optionality to grow? I think that's how a lot of growth investors should look at these kind of companies at this point in time. But don't everything growth lah, huh?
So I do agree with the panelists. And just to add on, tying back to the question about quote, right? I like the Warren Buffett quote about, don't invest in companies that you're not willing to hold for 5 years or something, right? Over a long term. And I think for myself, from a fundamental perspective, that's kind of how I see investing. When I pick single stocks and companies, even a growth company, yes, they're losing money, they're not paying out dividends, but are they going to have that winning edge? Are they leading and dominant in their space? Are they going to be relevant 5 years from now? I think we all know the famous story of Amazon, right? They didn't used to make money. Yeah,
only the survival story continues.
Yes, but I think that it's important to assess a company from that perspective, right? Do you think this is a company you will hold for a 5-year period? And there must be reasons behind it, right? Exactly, cash flow, how's their debt levels, right? Leverage and all that. And, at least you make that decision, right? When you choose to go into a certain company or hold a company through this bear market, you know why you're making that decision, and hopefully you get it right. Not every decision is going to be right, but you hope you get it right. So agree, important to do asset allocation, diversification. We always say, don't put all your eggs in one basket, and that's the same for investing.
Yep. No, I think I would add on that. I think it's cash flow. I think what Reggie touched on, for me, it's cash flow. If the company is able to generate, free cash flow, operating cash flow, then they'll be fine. But unfortunately, a lot of growth stocks, obviously going into this crisis, were not generating any cash flow. So I think you'll see the ones that do come out in better shape than the ones that don't.
And for
Yeah.
clarification's sake, you can also look at their cash, right? Based on the cash and their burn rate, you can kind of guess how many months or years can they survive. If they survive 6 months in cash, then you can balik kampung already, this company, right? It's not going to survive, right? So the basic operation of how you look at your own expenses, you look at the company is similar in that level.
Okay, thanks. Thanks everybody for joining the panel tonight, our esteemed guests. Yeah, please check out prosperous.asia for insights on markets and thank you for everyone for joining today. It was a good session. Thank you once again. Thanks.
Thank you, everyone. Thank you very much to our panelists. And I hope you have a good evening. Thank you to those watching at